your view on this? I mean, was it pretty much a surprise for all parties concerned?
Not really. I think it was in line with our expectations and the market expectations. I mean, demand was high, it was significant. I wouldn't say that it was exceptional, but it was quite high. And I think, well, it's because there is so much liquidity across the globe, and that interest rates in the US and the developed economies are extremely low, that we had this support in terms of demand. But also the fact that the Eurobond will have a size of $500 million helped, because that means that the Eurobond will be part of the emerging markets bond index, which is positive news in terms of secondary market liquidity. And finally, if you're an Africa fund and you focus on fixed income, well, I guess you couldn't miss this opportunity. So obviously, specialized funds also supported the demand.
Well, it's quite interesting. I mean, looking at the 7% that it was issued at, what does it say about the appetite for Nigeria's long-term dated debt and the fact that it is a 10-year bond?
Well, we expected a marginally lower yield, probably of 6.5, 6.75%. But that said, I think the 7% yield is broadly in line with Nigeria's macro fundamentals, as well as global fundamentals. I mean, let's not forget that the Eurobond is also priced based on the US, on the 10-year US Treasury. And actually, an interesting point is that Nigeria could have issued its Eurobond at a lower yield if it went to the market in late 2010, because at that time the 10-year US Treasury was trading at 2.5 plus minus percent, and it's now at 3.4%.
Well, it's quite interesting, Samir. If you had to compare the 10-year bonds that we see coming through from peripheral Europe and the likes of Nigeria, for example, the yields are not too different. Do you think that investors are going to be weighing up the fact that, yes, Nigeria has its own set of risks? We've got elections coming up. We're also seeing some problems perhaps coming through to the fore when it comes to oil revenues, and also the fact that reserves also under the spotlight. How do you see that then playing out?
Well, I guess, I mean, we're not talking about the same magnitude of fiscal issues. You know, in peripheral Europe, obviously the deficits are quite high, and it's going to be very hard to cut them. In Nigeria, well, there's going to be some fiscal consolidation. That's one. Then, secondly, I mean, reserves still cover 67 to 68 times the size of the Eurobond. So, frankly speaking, I mean, the risk of default is marginal here.
Okay, Samir, also comparing the Eurobond with the local currency bonds, which are currently yielding more than 10%, maturities over 3 years is what we're looking at. For investors seeking that exposure to the Nigerian market, what's your view on buying the Eurobond versus the likes of the local currency bond?
Well, I think we're talking about two different segments of the market. I mean, the Eurobond market is mostly an offshore market. There's going to be very little demand from Nigerian institutions, for example. That said, I mean, on the local currency side, what's interesting is that as some fiscal consolidation emerges in 2011, we expect yields to go down. And actually, we've seen this trend over the last few weeks. So the fixed income market is likely to be characterized by some kind of rally in the coming weeks or months. And I think it's quite interesting, especially if you take the duration trade. So if you buy the 20-year bond, for example, which has a duration of 8.5, and interest rates fall by 2%, for example, you know, you have a return of 17%. So it's quite attractive.
Definitely attractive. What about the secondary market, and how do you think various factors in the market are going to affect the secondary market and the pricing of the bond thereof?
Well, the secondary market is relatively liquid at some points of the curve. Actually, I think it's the most liquid in Sub-Saharan Africa, excluding South Africa. So one driver would be the level of supply. The Debt Management Office has said that it will issue 865 billion this year from about 1.18 trillion in 1.18 trillion naira in 2010. So supply is going to be cut by 27%. So obviously that should help the rally in the fixed income space. Another point is inflation. Inflation has been declining over the last few months. It's now at 11.8%, but we think it's going to fluctuate between 11 and 13% this year. So the fact that inflation is also contained should support the fixed income space. And I think the downside risks could come from the exchange rate well, in the sense that if the central bank feels that there is still high speculative pressure on the currency, it could actually at some stage hike its policy rates, which then obviously could have some impact on yields, at least at the short end of the curve.